Hello everyone and welcome to a brand new series that I have been wanting to create on this channel for a long time now. Now pretty much the purpose of this series is going to be to lay out the core foundations of what my strategy is. Now there is three core pillars when it comes to my strategy, and these three core pillars act as the steps I take within my approach when it comes to analyzing and executing positions within the financial market. So pretty much the purpose of this first episode is going to be to run you through the very first pillar or the very first step within this strategy. Now what that first pillar is market structure and understanding what our bias is within the market. So we're going to start off by simply walking through market structure, structural laws, and then as we deviate towards the end of the video, we will get a bit more advanced on this topic and start discussing the importance of establishing a bias and a story in the market to ensure that we are prepared to trade the market regardless of what is delivered. Now, these videos are actually going to follow along the guidelines set in place by the course that I established around about a year ago now, called Beating the Banks. That is a title that I called that series. Pretty much everything you need to know about the strategy and how to be profitable within yourself in that strategy is involved within the Beating the Banks course. Now, the purpose of that is pretty much just to ensure that if you were ever curious about my strategy, all the information is there for you to take away and try to learn yourself. But without getting too straight away, let's actually dive into the very first topic. So why do the markets have structure? Now, obviously we know a financial market is there to represent data. Now, a financial market is representing, especially a forex pair, the exchange rate of two currencies over time. So obviously our x-axis is representing time, or a time span, time frame, and then the y-axis is representing the price of that currency pair. Now, of course, we know that we have a base currency and a quote currency. On this, where we see the euro to the US dollar, obviously the base currency there being the euro, and then the quote currency being the US dollar, which means that for every €1 you have, you could exchange €1 to exactly, as of right now, $0.99475. So within this financial market alone, we are understanding that the data being represented here is the exchange rate value of €1 to a US dollar. So over time, we can see that this price has obviously changed for the past few decades, as it will. Obviously, economic factors around the world are going to differentiate either the confidence or worry within a certain currency, which is going to cause investors to put more money in or pull away, or when we see inflation measures rising, interest rates rising or depreciating in an economy, obviously then the value of that economy's currency is going to differentiate itself. So these markets are pretty much just set up to show us and showcase data over time. Now, we may think that that is very independent, that the structure of a market therefore must be completely random, because we never know what could happen in the world to therefore change that valuation of either currency. This is where you would be wrong, because we have something called structural laws. What that means is that there are certain things that happen in the market, and there are certain laws that structure follows, where we can predict what will happen, because within a scenario, there is always going to be a more likely option or more likely scenario that could play out. So one thing that we must remember, and this is a very, very, very important topic for us to understand before we dive into anything, is what I like to call the fractal nature of the markets. Now, technically, there is an unlimited amount of time frames we could view a market on. Now, right here, I am on the 1 week time frame, which means that every one of these candlesticks represents 1 week of price data. So this candle is representing what happened within one entire week and what price did within that entire week. Obviously, we can change this. We can go to 10 years, 5 years, 1 year. 3 months, 1 month, 1 week. We have a vast range of time frames we could go down to, all the way to every single tick or every single microsecond. So the idea being that each time we go to a time frame lower than the one we are currently viewing on, we are fractalizing that structure, because we are viewing what we have just been seeing in a more fractalized way. So for example, if we look inside of, and let's scroll down, if we were to simply highlight this region in the market here on the 1 week time frame, we can see a move down and a move back up. Okay, now what we can do is we can fractalize that, and if we go down to a lower time frame, what simply seemed like a move down and a move back up, we can see there is now a lot more information there, because where we were once on the 1 week time frame, we are now on the 4 hour, which means if we calculate how many 4 hours there are within a week, that is going to be 6 times 7, 36 times more data. So there is 36 times more data now in this region than there was before. So we fractalized the data that we were once seeing by 36 times. So we are now seeing 36 times more data. Now what that means, and what the point I'm trying to get at here, is that the market can always be fractalized. Arguably, and the way we should view it, is an unlimited amount of times. So we need to understand that the markets are constantly going to be doing a vast range of things dependent on the fractalization of the market you are viewing, or dependent on the time frame you're looking on. So where before, when we were on the 1 week time frame, it simply seems like a move down and a move back up. When we go lower, we can see that what was once a move down and a move back up has been many moves down, move back up, move down, move back up, move down, large move back up, so on and so forth. Now, what this is the fact that we have certain phases and certain trends within a market. So I would argue that we have 3 main phases within the market, and it's very important that we understand what these phases represent and why we have them in the market. So let's discuss that. Now, typical structure that we are going to see within a market varies time to time, but I would argue we're going to see something along the lines of this. Okay, now this may just seem like some random market structure, a move up, a move down. But we've actually had 3 different phases happen in the market here. First of all, we've had an uptrend. Now, what an uptrend is, also known as bullish structure, is where a market is moving up, or from the start, A to B, we have moved up. In order for a market to move up, it must produce bullish structure. Okay. The second phase we have is something, there's many names for it. A lot of people say a ranging market, consolidation. As we move into the later episodes of this video, this phase will make a lot more sense. But for now, let's just say it's a sideways phase in the market. Now, within a sideways phase of the market, it's typically just representing the end of one trend and the creation of a new trend. So the end of an uptrend and the start of a downtrend, which brings us to the third and final phase, a downtrend. So a downtrend, or most commonly known as bearish structure, is where price moves from A to B, it moves downwards. So if we pick a point and that point is A, we then pick another point and that point is B. If price has moved down from A to B, we know that there must have been bearish structure created or a downtrend created. Typically, at the end then of this trend, we would see another ranging or consolidation phase in the market before another uptrend. So let's argue that one phase of a cycle in the market is going to represent one uptrend or bullish structure, a period of consolidation, one downtrend, and a period of consolidation. So we have one uptrend, one downtrend, and 2 periods of consolidation represents one cycle within the market. Now, taking this back to the fractal nature of the market, we can see that within one single cycle of the market, we can pick an area, for example, this region right here. We'll identify that in a different color to avoid confusion. Let's do that in purple. And within this purple structure, if we were to go to a lower time frame, this area inside the purple box would look the exact same as this overall thing we have drawn out, where on the lower time frame, inside of here, we would have an uptrend or a bullish phase into a region of consolidation, into a downtrend or bearishness, into a region of consolidation, and then a move up. Now, this is a representation of the fractal nature of the markets because we could do this an infinite number of times. As I said, we could go from the highest time frame possible to, like a century if there was enough data there, all the way down to an absolute microsecond. So within each period between that, we could do this process where, again, we said this is our overall market cycle that we've seen. If we take a look into one portion of the overall cycle, we know that there is a single cycle within that one portion. We could then take another portion, for example, this region right here, and let's say we put that in green, and we could see the same thing again in this small portion. And we could continue doing this an infinite number of times to find out the most fractalized cycle in that market. Now, this is all going to make sense soon when we go towards the end of the video and we talk about establishing a bias and a top-down analysis. But as of right now, we just need to understand that concept. Let's actually now go back to these different phases. So let's just stop that confusion and remove these drawings for now. So we have 3 different phases. Let's actually dive into each one of these phases to talk about typical structural laws within each of these phases. So to start off with, I want to start with the very first phase, an uptrend or bullish structure. Now, in order for us to know that structure that we are viewing in the market is bullish, there's a couple of things we need to see. So the first thing is we must identify the swing points. And what that means is that each region of consolidation we have in the market represents a swing point, because that is a point of reversal. So we see that we've had a point of reversal here, a point of reversal here, a point of reversal here, here, there, and there. Each of these points of reversals are key swing points in the market, which are going to reveal information about the current structure. Now, what we can see is that each time a high is created, because these are swing high points, and potentially let's change their color so that they make more sense. We'll change all of the swing lows to red, and all of the swing highs are going to be in blue. So we see that every single swing high that is created, or every single new swing high that is created, is higher than the previous swing high in the market. That is what we call a higher high. So we see that this one that is created is a higher high, also known as HH. Now, when we have bullish structure, we will always see the continual creation of higher highs. The second that we see a high created that is lower than the previous high, that is an early indication that that bullish trend or that uptrend is coming to an end itself. So we have higher highs. On the flip side, we see the new lows that are being created are higher than the previous lows in the market. Therefore, they are representing higher lows, or HL. Now, again, in order for bullishness to remain intact and to continue, we must constantly see every low that is being formed be higher than the previous swing low in the market. So that is 2 very important things to know, is higher highs and higher lows. Now, a bit more information on these higher lows in the market, and something we've discussed is that we are taking the assumption that if a low is broken, that is an indication that the trend is over. Therefore, we can argue that each time a new low is formed in bullish structure, that low should be protected. So let's walk through that. So let's follow price. We've had a move up, we've created a swing high, a move back down, we've created a swing low. Now, let's just make the assumption that in order for a protected low to occur, we must have a pair of a swing low and a swing high. Now in the case of bullishness, the pair must start with a swing low and end with a swing high. So this move here represents one pair. Now what happens is that as soon as we break the previous market high, therefore creating a higher high in the market, the second we create that higher high, we are also protecting a new low. So this low that was created in this pair becomes protected the second the previous high is broken. So the second we had price push past that level, this low instantly becomes protected. The reason why is because once we have a higher high in the market, we know that in order for structure to continue, this low must be held. If price was to break the previous high, therefore delivering that higher high, and then move lower, surpassing that low in the market, it is then extremely likely that that trend is over. So that is something we need to be aware of, which is protected lows. So following structure, the second that higher high is created, this low becomes protected. We move down, we create a swing or a swing low, yet it is not protected until the second we break this high. The second that high is broken, we can then say that this swing low in the market should now be protected. We trade up, new higher high. We create that low. The second price surpasses that level, this low then becomes protected. We can see then what's happened here is the second that low has been protected, that is when the trend has changed from an uptrend into a downtrend. Now, the final thing that we need to be aware of about bullish structure is something called the types of structure we can have, whether that be aggressive or slower. Now, in order for us to do this, we need to be aware of something called impulsive and correctional waves. Now, an impulsive wave is a move in the direction of that trend. A correctional wave is a move in the opposite direction of that current trend. So in an uptrend, every move higher is an impulsive wave. So this move higher represents an impulsive wave. This move lower represents a correctional wave. This move higher represents an impulsive wave. We can use arrows to display that, and I will also flash some images on the screen now, which will depict the impulsive waves within bullish structure. So we can see that that green arrow is representing an impulsive wave. The red arrow will represent a correctional wave. So within this, we have impulse, correction, impulse, correction, impulse, correction, impulse because we create a new higher high. And then the second that a correctional wave comes to penetrate a protected low, and let's just draw on all of these swing points so it makes sense. So the second that the protected low is broken, it can no longer be a correctional wave, because for a correctional wave to be a correctional wave within bullish structure, that correctional wave must hold the previous low. So as this correctional wave trades down, it must hold and reverse above the previous low set in the market. If price surpasses that previous low, like it has in this example, it is no longer a correctional wave in bullishness, because it would have had to protect that low in order for it to be a correctional wave. So in that case, when we see a protected low broken, rather than this move lower being a correctional wave, it is actually the first impulsive wave of bearishness or a downtrend. So in this case, in a downtrend, every move down is our impulsive wave. So we go impulse, correction, impulse, correction, impulse, correction, impulse. Okay. So in this case, the green arrow, which represents our impulses, is going to be the opposite way round, because that is our impulse and that is our correction. So this is why understanding where protected lows lay is very important. Now this is where we can actually talk about something else, which is a break of structure. So in bullishness, when we see a protected low broken, that represents a break of structure, or a BOS. So this penetration of that level represents a break of structure, and a break of structure represents the change of a trend. As we see, that's exactly what's happened here. A protected low has been broken, signaling a change in trend. that change in trend is where we can see the very start of bearishness, where we've had a single impulse down and a single correctional wave back up. So now let's discuss bearish structure. Now in bullish structure, we had higher highs and higher lows. In bearishness, we have lower highs and lower lows. So if we identify the swing points, we can actually depict that. And then on the flip side, we have these. Okay, so we see that all of the swing highs created in this region, every time a new swing high is created, the high is lower than the previous swing high left in the market. What that's representing is lower highs, or LH. Now, that is when we can identify that structure in the market is in a downtrend or bearish, when we see lower highs and also lower lows. So it's going to be LL. Now, if we are seeing both lower highs and lower lows, that is when we know a market is bearish. That is when we know we are currently within a downtrend. Now, within bearish structure or a downtrend, we have something called protected highs. So every single time the low is broken, okay, so in this case, in bearishness, every single time the low is broken, we get a new protected high. Now we can assume right here, once this low is broken, this high should be protected. Now what that means is that when this low is broken, the correctional wave can reverse anywhere below the protected high in order for the structure to remain bearish. In order for this move to be a correctional wave, this high must be protected. So just to recap, in bullish structure, our impulsive waves are up, our correctional waves are down. In order for structure to be bullish, we must see higher highs and higher lows being formed. In order for bullish structure to remain intact, we must see that the protected lows are held. If not, that is going to signify a reversal in the trend. When it comes to bearish structure, in order for bearish structure to be valid, we must see lower highs and lower lows being formed. Our impulsive waves are down, our correctional waves are up. And again, in order for that structure to remain intact, we must see the highs be protected. When the high is broken and we are delivered with a break of structure, that is an early sign that the trend is reversing and we are then seeing bullishness. Now, the other point I wanted to get involved with is the types of structure, because sometimes we can have more aggressive, sometimes we can have slower. Now, in order for us to identify this, we are using the length of both the impulsive and correctional waves. So in bullish structure, we can say that both of this structure that I'll draw out, let's move those apart ever so slightly. Okay, so this is structure A and this is structure B. So let's draw that on. So that's A, this is B. Now, structure A and structure B both represent bullish structure. Why? Because we are having higher highs and higher lows being formed. The protected lows are being protected and the highs are constantly being broken. So we are constantly seeing higher highs and higher lows formed. Both of these types of structure represent bullishness, but we can see that they are vastly, vastly different. Now, in this structure, we can say that in both A and B, price has moved the same distance upwards in both structure A and B. So let's say we have moved up a total of 5%. Okay, in both examples, we have moved up 5%. The difference is that in structure A, it took a lot longer for us to increase by 5% than it did in structure B. Now we can see, as we said, by the X and Y axes, it has taken a much longer time from price to get from A to B in this example than this one. Now what that means is that this structure was much slower and this structure was much more aggressive. Now these are two types of structure we can see in the market. Now it doesn't always mean that within a single trend we can only ever be slow or only ever be aggressive. we can have a mix of both A and B together. For example, we see that we have a parameter of structure A where we've had a impulsive wave, the correctional wave has been very deep, an impulsive wave, a shallow correctional wave, impulsive wave. So we've had components from both A and B in that structure, which can happen, but we need to understand that one structure is more aggressive than the other. When we have structure B, or the more aggressive structure, that is a sign that there is more buying power in the market, and that trend, or in this case the uptrend, is in more control because we are moving higher at a more speedy rate. With slower structure, that is obviously an indication that there's slightly less buying power in the market because we are not moving up as fast. So we can actually analyze, in both cases, the length of the impulsive and correctional wave to identify the type of structure or the aggressiveness of that structure. So the longer the impulsive wave is and the shorter the correctional wave is, the more aggressive that structure will be. We can see that the ratio of impulsive wavelength to correctional wavelength is very different in this example to this example. The higher that ratio is, the more aggressive that structure is. Let's say that this single impulsive wave here was 100 pips. This move back down was 20 pips. That's 100 to 20, which is 5 to 1. So we have a ratio of 5 to 1 in impulsive wave to correctional wavelength. The higher that ratio is, the more control that trend is currently in. For example, if we look at this one, we could be looking at 100 pips up to 75 back down, which is obviously going to be 4 to 3, which is a much worse ratio than its latter, structure B. Obviously, we have the flip side when it comes to bearish structure. I'm sure we don't have to draw that out. It would literally just be a case of flipping this round, but understanding that we can take the ratio of impulsive wavelength to correctional wavelength to therefore identify the aggressiveness of that current structure. Okay, so I now feel pretty confident that we have walked through all the major structural laws I believe you need to know. Bullishness, bearishness, so inside of bullishness, higher highs, higher lows, protected lows. Within bearishness, we have lower highs, lower lows, protected highs, and then also understanding the 3 different phases of a market, understanding that those 3 phases represent one cycle in terms of structure, and then finally understanding the types of structure we can have in the market, whether it be more aggressive or more slow or slower structure being created, and how that can tell us what's happening in the market in terms of whether that trend is in control or in more control as of current, dependent on the structure that is being delivered. So that's going to be all those structural laws out the way. So the next point of this video that I want to dive into is creating a bias and creating a story, and how doing so can help us understand how to trade the market, help us have probability on our side, and help us be more successful longer term. Now, in order for us to do that, we're going to take all of those structural laws we've just talked about and identified, using the fact that we know the information provided by those structural laws will allow us to gauge probability in our hand and understand and predict the most probable next move in the market, given what those laws are telling us in the market at any current time. But I believe we will save that for part 2 of this video, because we've already spent a very long time going over all of these core pillars and fundamentals of structural laws, which are all extremely, extremely important for us to know. In the second part, we can expect examples in a live market, and then how we integrate all of that together into step 1, which is finding a bias, finding a story, using the structure in a market. So hopefully you've enjoyed this part, and we'll see you in part 2 to discuss this topic further.